I'm really looking forward to this real estate panel. So we're going to have Mike Kondracki from Wawona Worldwide lead the panel. And then we've got a great cast of speakers. So, and one of them is here, which is Josh Greenblatt. So I'm going to let Josh come up and then Mike can start introducing the group. And then with the group intros over, I'll stop the polling and we'll release the poll to the group and they can react and respond and go on with their discussion. All righty, Josh?
Mike? So Mike, you want to get started?
Okay. This panel is a panel on real estate that is going to talk about the market and their unique investment approaches in 2021. I myself am in the market as a commercial mortgage arranger. That's what Wawona Worldwide Capital does. And I also raise capital for a pre-IPO fund called Eagle Private Equity. With us today are Robert Mason, General Partner of Mason Capital Partners, Josh Greenblatt, President of Choice Housing, and Josh Roach, Chief Investment Officer of Lloyd Capital Partners. Perhaps we can get started. Josh, you want to take it over from here?
Sure. So my name is Josh Greenblatt. I'm the president of Choice Housing Investments. We are an equity company that was established to be the strategic capital partner for a developer, owner, manager of multifamily housing. We focus in, we're in multifamily, but we focus in both the affordable and workforce spaces. Currently, we have 7 investments, 6 in Texas, and 1 in just outside of Albany, New York. It's about 1,500 apartment units in which we own, and those were acquired starting in late 2019 through June of last year. We just wrapped up our annual numbers, and the portfolio performed at a 9.25 cash on cash return, which we think is stronger than we projected, but certainly even better in light of the pandemic that we're currently hopefully moving towards the end of. So that's a little bit about me and Choice.
Very good, Josh. Robert Mason, you want to take a crack at the panel?
Sure. My name's Robert Mason. I'm from Atlanta, Georgia. I'm the founder and managing partner for Mason Capital Partners, which morphed out of a family investment business we started in the real estate world about 40 years ago. We've done about 100 investments to date throughout the Sun Belt, from suburban DC down through Fort Lauderdale and out west as far as Texas, and we've looked in Arizona and beyond. We are agnostic as to asset type. We are very, very focused on who we partner with. The vast majority of our pipeline these days is in Central Florida. We work very closely with Lincoln Property Company. I used to work there. Really our whole strategy is to create sort of an investment club that my family leads. We have several other families that invest with us. We'll get in early in large urban mixed use projects. We'll do apartments, suburban, we'll do assisted living. We just partner with what we consider to be best in class operating partners. We'll get in early. We invest at the sponsor level for reasons that we can get into. We felt like that's been a terrific strategy for us to allow us to diversify and earn higher rates of return. We're big on alignment of interest. And again, we're really focused on, at the moment, on Central Florida, just because we've seen a massive influx and we feel like the supply demand dynamics are very favorable there right now. So that's really sort of what we're up to.
That's a very nice overview, Robert. Josh Roach is Chief Investment Officer of Lloyd Capital Partners. Maybe, Josh, you can say a few words about Lloyd.
Sure. Good morning, and thank you, everybody. Thank you, Marty, for having us. It's nice to be back in the group again. So Lloyd Capital Partners is a single family office of the Lloyd family. It's a 6th-generational family. I represent the investment office along with a co-manager, and our goal is to allocate capital on behalf of the Lloyd family across both public markets and private markets. One of our core internal strategies we run is real estate with a subsector focus only on single family residential development. We've been doing that since 2006. And we focus particularly these days on single family rental. So that's SFR. We'll talk a little bit more about that and why we like it. There's some really good structural impediments in the housing sector that compel the opportunity. And we also sponsor capital or provide capital at the sponsor level. And we also work directly with operators onto our platform. So we'll bring a specific operator onto our platform for the duration of that strategy and help build that operation out over time. We've had over 1,500 housing units that we've invested in over the duration and continue to build up the single family rental portfolio to date. Our focus area is in Southeast US.
Very good, Josh. A question we have for the panel. Why don't we go to Josh Greenblatt, and he can tell us why he likes to focus on affordable multifamily and workforce multifamily, and how he determines his geographic and market preferences.
Great, thank you. So the reason we're focused on affordable and on workforce is really we like to do well while we do good. We the developer that I'm affiliated with, I had worked there for 22 plus years. It has always developed in the multifamily space, in the affordable space, really looking utilizing the low-income housing tax credit. There are currently they operate in 7 states plus Washington, D.C. And we formed Choice really as an offshoot to get involved in newer properties that didn't have a significant rehab need, but could still further the mission. And what we've really liked is and benefited from is that this is categorized really as impact investing. We look at it as there's a double bottom line, both confidence in the cash flows that we're going to receive, and we can be good stewards to both the properties or combination of the properties, our residents, but also to our investors. Additionally, we're providing a positive social impact. We're mostly renting to those whose income is at 60% of the area median income, and providing homes to people who are who need homes proximate to their place of work. So we have many teachers, entry-level firefighters, police officers, nursing, retail staff, all of those that really, if not for our kind of offerings, wouldn't have convenient homes to their places of employment. So we really like that double bottom line that I mentioned. And in terms of geography, we, as I say, the developer operates in 7 states. We're currently focused in Texas and in New York, but we're also opportunistic, and we do look to identify properties and opportunities for investment really all over the country. We're based in Connecticut, but we have reach all as far as the internet and air travel will take us.
Are you seeing anything, Josh Greenblatt, in the construction area? You mentioned you're working with a developer. Are they doing any ground up in this area, or are you simply acquiring assets based on cap rates?
So we don't do much ground up. The developer does some adaptive reuse. We have a few deals under agreement where they're taking one in Cleveland, Ohio, where they're taking a school that's been mothballed and turning it into the school itself will have residential units that will be converted to residential, and then some of the ball fields that are adjacent to the school will be some new construction. That's an interesting project. It's benefiting from both the low-income housing tax credit as well as the historic tax credit on the school building. But what we're primarily looking at is buying existing properties and doing a value add, a light rehab. We do between say 5,000 and 10,000 per apartment unit, and that's where we find that the best investment opportunity is in our space.
Going to segue over to Josh Roach for a minute. Josh, you had mentioned that your focus is single family resident, SFR so called. What kind of expected ROI do you see in these kind of investments, and what is the average duration of the investment?
So there's two ways to access this market. There's obviously public market vehicles. You can access those are REITs, and those are probably upper single digits. The space we operate in, though, is we're actually owner operators, and so we actually will take a single family home, provide light renovation to it, and operate that to a certain cap rate level, and then put a renter in that house. And so at that point, we're building up a portfolio of homes which we renovate and then property manage, and we collect those rents. And so we operate those to about between a 7.5% and 8% cap rate. That's number one. And secondly, cap rates in the SFR space. So the goal is to sell this portfolio, Michael, right? We get a number about 500 to 700 homes in the portfolio. You sell that portfolio to a larger mid-market buyer or to a public REIT. Those REITs today are trading at about 6 to 6.5% cap rates. So that's 200 basis points of cap rate compression. So think about the return in that way. The other way to think about it is you should probably expect generally across this asset class somewhere between a mid to a high teen return. If you're partnering with someone like an operator who's actually doing the in the trenches work as opposed to just allocating to a public REIT. So there's more operational risk, rehabbing that property, property managing that property, but the return should probably be somewhere between 15 and 20% IRRs on that. And I already talked about the cap rate compression that's available today in the market.
That's very good for a commercial real estate investment, and I think shows the strength of multifamily and SFR investments today. Robert, you had mentioned that your strategy is asset class agnostic, and maybe you want to talk a little bit about that, as well as what you're doing in Florida, which seems to be a geographic preference right now.
Yes, it is. We have, over the course of our 40-year investment history in real estate, we've done a little bit of everything. We started with industrial build-to-suits. We've done some medical office. We bought retail strip centers out of foreclosure during the RTC days, but we were always managing our own investments. What we found as the pool of capital grew was that that investment strategy was somewhat binary. It was great to put a deal together as long as that tenant stayed hitched and stayed on the lease. But what we've morphed into now is a strategy where we're taking our family's capital and several other families alongside of us and writing smaller checks and partnering with first-in-class operating partners like Lincoln Property Company, where they're strong. So we're following them around Central Florida, which makes us somewhat asset agnostic. We're more focused on the geography and who our partner is. We love Florida because Orlando and Tampa right now, according to some of the data we're seeing, are the number 3 and 4 cities in the nation in terms of net in-migration. So massive amounts of growth. not as much competition. And with Lincoln, we delivered Church Street Station Phase 1, which is the headquarters for SunTrust Bank, now Truist Bank. And it's a mixed-use tower with parking, office, and then a hotel on top that we sold off. We've got a second tower planned, which we'll break ground on this year. We've got several other apartment developments as well in Orlando. And then in Tampa, the metro area of Tampa, we bought the headquarters for the Tampa Bay Times newspaper. We've shrunk the paper. Their credit's a little bit weak, and backfilled it with a defense contractor, a law firm, and taken advantage of the fact that the St. Pete market's just on fire. So we love office, in certain situations. We love mixed use. We're also going to be redeveloping West Shore Mall in Tampa. We're buying the Sears parcel and the parking lots, and we'll put sort of a town center in Tampa right near the airport. So that there we'll use, we'll put in apartments, retail, office, medical office, and a hotel. So we'll create sort of a town center. So we're not as focused on the asset type. We're a lot more focused on who our operating partner is and sort of where we're going. We like high barrier to entry projects. And then we invest at the sponsor level. We'll bring in a lot of other equity and we'll secure the debt. And then we'll write small checks in a lot of large projects. That's sort of our approach.
That's very interesting, Robert. And I gather that Lincoln is really your source of deal flow from a majority perspective.
Yes, we've done deals with Pope and Land, who's another sponsor here in Atlanta. And we've got two other groups, an apartment developer out of Atlanta that we work with, and another assisted living operator happens to be out of Central Florida. But Lincoln alone would be a career. I think there are probably 15 deals they've got right now in Central Florida that we're looking through.
Josh Greenblatt, maybe you can talk about your geographic preferences and how you source deals and what differentiates you from other multifamilies in the space.
Sure, thank you. So in terms of geographic preferences, what we really look to is really two key economic drivers. One, we want to see good, strong job growth. We also want to see real estate tax certainty. Taxes are always going to go up at a transaction, but if it's predictable, if it's something that we can model, we're much more comfortable with that than the unknown. In Texas, we've been able to leverage. There's certain partners that afford you a real estate tax exemption, and so we have 4 of our 6 properties that we currently own, as well as 4 properties that we have under agreement that all have 100% real estate tax exemptions, and that ends up being a differentiator and allowing us to deliver strong returns to our investor base, strong predictable returns. Another, I guess, a key differentiator for us is that we are affiliated with a developer that has a long-standing track record, a nearly 40-year track record, and we were built off of their success. As I said, I'd been with the developer for about 22 years now, and we've been able to build up through that positive track record. We have relationships with sellers, with attorneys, with law firm, or with attorneys and law firms, with accounting firms, with lenders, that we're able to see deals before they hit the market. And I think that is, we're giving our investors access to deals that they wouldn't otherwise have access to. And one of the things that we see in our space is once deals do hit the market, the prices get inflated, and so we're able to cut that off and access deals prior to that happening.
Very good, Josh. Turning over to Josh Roach. Josh Roach, how do you see the SFR market today? I know that There are websites that cater to fix and flip. There are websites that cater to turnkey rentals being available. You can't, even if you're a subscriber to Netflix, you can't watch it without seeing some focus, if you will, on a retail level of SFR investment today. I know you said that Lloyd is a sixth generation family office and that you've amassed a portfolio of 1,500 SFRs. Perhaps you can talk about where you see the future.
Sure. Just a couple things. We've done 1,500 homes over the life of our investment in single-family residential development. That is a little bit different than SFRs. SFR is single-family rental, is a sub-strategy within single-family residential, number one. Number two, look, so we partner with real estate operators that we don't do fix and flip. Today, all we do is we buy single-family homes in the southeast of the U.S. We put about $25,000 of renovation dollars into that, and then we lease that house out to a tenant in the area, typically to a workforce housing unit. So similar to what Josh was talking about. Look, the goal today is to provide workforce housing to those folks who maybe cannot afford the underwriting requirements of 20% down on a home, and provide them a very nice home with upgraded amenities and in an affordable price range. The reason why the opportunity exists, Michael, is really simply because there are households being created today. It's called household formation that is significantly in excess to the number of homes that are available for people to move into. And I'm talking about single-family homes and not apartments. So there is a complete mismatch today with the number of people that are looking to move into a home, out of an apartment or out of their parents' basement and into a home. So that is the first kind of structural problem that creates the opportunity. The second, there's just not enough homes being created at the lower end, at the workforce housing level, and there hasn't been for quite some time. And that's mainly related to the cost of property going up and the cost of materials going up. And it's often hard to find the economics unless you're a very large operator to buy these at scale, or you can amortize the cost of that development long over a period of time. And thirdly, I would say that the mortgage rates are fairly low. And so for a commercial developer to provide and buy these homes at scale, you can really kind of arbitrage the long-term rate of holding these homes and then the rental fee you collect on them. And so it's a significant long-term advantage. You have people that are going to continue to move out of their homes and into, or out of their apartments into single-family rentals. The millennial generation today would rather subscribe to a home rather than buy a home, simply for the fact that they don't want to have a job where they can't leave that job or they can't leave that city for the next job because they have to sell their house. They don't want to be anchored to a long-term asset. They want to have mobility and move to where the jobs are moving. And so long as they can subscribe to a home and own a home for a period of years, then that makes it asset light for them and allows them to be competitive in the job market.
That's very interesting, Josh Roach. Question for the panel, and I'll just put up this question. How has artificial intelligence weighed into your business? Do you use it to source opportunities? Do you use it for cost advantage? Maybe Josh Greenblatt can take a whack at that one.
We haven't used it for sourcing deals, but we do use it. We do use it for the underwriting. And I think what it does is it allows us to help to better underwrite deals at scale. We can use it to better predict rental revenue, and that's an area where we've seen. We can, pick a market where we may not have our own experience, but through certain tools that we have access to, we can determine what the maximum rent we would be able to achieve would be, and see if there's an advantage from the maximum rent to the rent that's currently being collected, and how certain improvements may impact that. So I think that's really the clearest way that we use it.
Another question for the panel. Do you think there are technologies and software available to minimize more in this market delinquencies, maximize the proceeds that you see from rent? Maybe Robert Mason, you could take that question.
Yeah, it's funny. I joke that real estate is a dinosaur industry. We're highly capital intensive. It takes a long time to develop the large projects that we do. We are seeing technology enter. We're seeing it enter in terms of, how parking operates, for instance, the ability to scan a license plate, and bill someone coming or going. I mean, you see, technology like Zoom that makes it possible for meetings to take place across the country, which is cutting down on hotel travel. It's been a big boom during COVID. It's accelerated it tremendously. So we're seeing technology impact everything. Going into a hotel and checking in with your phone if you want to through the Guild or Sonder, where you don't even have to see anybody at a desk. You can tell them if you're renting an apartment like you would rent at a hotel. You can, use your phone and tell them what to stock in the fridge for you when you show up. So technology is definitely impacting every single sector of real estate. In terms of rent specifically, it certainly helps, perhaps more in multifamily than office. At the end of the day, with office tenants, they're large, and we do a lot of office. You need a relationship. You need to be talking with your tenants, during COVID in particular. But I think the ability to allow people flexibility in payment, the ability, accounting, I guess, has changed as well. But I'm a little further away from the technology. Our operating partners use that, but I'm seeing it impact literally every single asset class and every silo. So we're aware of it from an investment standpoint more than from an operational standpoint. But real estate is still perhaps a dinosaur industry, but we're really changing fast. And so it'll be exciting. And I think that does create some tremendous opportunities within the real estate sector. And our operating partners are certainly taking advantage of that.
Michael, let's just say something quickly on that, because we actually use technology just for the purpose you asked about how does it impact rent? So in single family, I think the best in class players manage and own the property management component of their business, and they do not outsource it. So the key is to minimize downturn, right, in your home, minimize the turn. You want to have people in their homes. You don't want to have an empty apartment. So one of the things we found in how the best in class operators is you want to keep that tenant in your home as long as possible. And the way that you do that is you have that one-on-one relationship with them, right? And the way you do that today is through a portal. You're constantly communicating to them one-on-one through a portal. You're allowing them to pay their rent that way. You're providing financial literacy to them if it's a workforce housing or an affordable aspect. You're providing pet services, other community service to them. So you're completely using a customized portal for your communication to them to continue to build and kind of morph that relationship with that tenant to keep them in that home. And we found that's materially helpful to mitigating any rent loss.
That's great, Josh. That's kind of what intuition would say. I know from operating in the commercial mortgage space that probably over half of my business right now is construction, particularly multifamily, we're doing an $8.5 million construction project for multifamily in Brooklyn right now, and a horizontal development in Maryland right now. I'd like the panel to comment on the ongoing dominance potentially this year of SFR and multifamily investments. Is that a trend you see continuing throughout 2021?
Absolutely. I'll take a quick stab and then pass it over to Josh Greenblatt, but it's continually going to happen. SFR is going to continue to be an asset class that a lot of people want to live in a single family home for privacy reasons, particularly in light of COVID. They want to have the home owning experience without the burden of owning the home long term. And so it's huge. The other thing is going to happen is you just have a significant gap between the number of homes available for people to move into and the number of people that want to move into a home. And so that's a structural problem that won't be filled for a long time. So, and then on top of that, you've got this millennial issue that people don't necessarily want to own homes. They want to take their capital and invest in their education. They want to take their capital and invest in experiences. And so long as those trends continue, there's going to be a significant opportunity to earn significant yields way above the risk-free rate in this market.
As far as the multifamily space, we certainly have seen through the past year, and we anticipate that it's going to be the same going forward, that multifamily is among the highest performing sectors of real estate right now. And within multifamily, what we see in the affordable side is that there are, in normal times, there were 10 renters for every available apartment unit, on the 10 renters that would qualify for an affordable unit for every available unit. What the pandemic has done is it has increased that number. The renters that had been in potentially a Class B or Class C housing, unassisted housing, or unrestricted housing unit are now qualifying for affordable, certainly qualify for workforce. And so the reliability and the confidence in high occupancy and in high rental revenue is going to be there. And that's what we've benefited from historically and what we anticipate to be able to benefit from going forward.
Great
Robert,
comment.
go ahead.
The only thing I would add very quickly is there are markets that are booming now, Florida, Texas, chief among them, because of the low tax environment, no state income tax, great government, good infrastructure. So we're seeing a massive shift from certain parts of the country that are high tax and maybe losing jobs to places that are creating jobs. And that only exacerbates the fact that there are millions fewer units than we need, housing units than we need. And then our look at that would be that, you know, we're looking at where those rooftops want to be, whether it's, you know, in a city center with walkability, which was certainly the trend before COVID. Now we're seeing more town centers and suburbs, you know, where their schools are good, et cetera. But the demand for rooftops is not going to slow down anytime soon.
Right.
Talking about rooftops, I'll pose another question. What do you think the future for solar is with regard to rental properties? Maybe Josh Roach, you have an idea on that.
Sure. So look, I'm only going to theorize because at this point, the economics are not sensible yet. Or let me say it a different way. We don't see best in class operators actually deploying solar at scale because the economics just don't quite work yet. Now, that's in single family rental. I want to be precise and distinguish that from the new emerging asset class in this space called build to rent, which is gaining significant ground. You have the opportunity to build a brand new home from the ground up and then put, you know, maybe some solar into that. Now that's going to be a higher priced home. So you have to be aware of who's going to rent that out. So those economics are still being worked out, but we're not there yet. But I think that would be something to look at, but it's not baked into the projections, certainly for 21 or 22 yet.
Robert, does solar impact your business? Do you see yourself adapting commercial to solar at any time soon?
We're looking at everything. We've looked at, basically stacking cars vertically where you drive in and your car is picked up by a machine, to save on parking costs. We've looked at solar. We've looked at all of those things. And to Josh Roach's point, as it becomes feasible, we would certainly consider adding that. Some of that's tied to the cost, obviously, of producing the energy. So, as there's a rise in cost there, then solar becomes more feasible. But I see that as something that we will definitely be doing more of in the future.
Very
We
good.
do have,
Go ahead, Josh.
really, it depends on locale and depends on what incentives there are available in the community in which the real estate's located. For example, we have a few properties in Connecticut that do have solar, have had solar on their roofs for more than 10 years. We have a development that our partner is doing in Washington, D.C., where there are strong, robust incentives to install solar. But it really all depends depends on what's offered in the state. In a state where there's a lower cost of energy, I anticipate that solar will be not as widely adopted. It all varies.
And as it becomes a larger factor, it will become cheaper to produce, I think, is what we would all guess. So I would say that, while it's not here today, it's coming, would be my thought.
I noted that Michael talked about the tax regime and the Biden administration and midterms. Would that also bode well for the Southeast and low tax regimes in the future? Is that a trend you see continuing? Migration to the Southeast?
There's huge migration issues to the Southeast. So that's going to continue to happen. You've got the low tax regimes. You also have in the multifamily, particularly in the single family residential space, you have the opportunity to capture significant depreciation. So it's a really interesting tax advantaged asset class. It gets a little bit more in the weeds, but we can certainly talk about it. That's most people don't really think about, but you capture that depreciation. So not only are the migration flows going down to the Southeast and the Southwest, but you've also got the interesting components of residential investing to capture the depreciation around residential and commercial.
Yeah, we are doing a cost segregation study now on SunTrust Plaza, which we just delivered, which will accelerate, from 31 years on a lot of line items down to as few as 7. So you can take massive depreciation and shield a lot of income. So that should not change. We're watching to see what happens with 1031 exchanges and with the capital gains tax rate. But we are seeing the net in migration into the Southeast being a larger factor potentially than either of those offsets, just based on the sheer number of people moving in and the lack of supply. So we're very excited about the future for Florida and for Texas in particular.
We do cost segregation analysis where appropriate and where applicable, and all of the returns that we talk to our investors are do not factor in the tax benefits that they would see as being part of this investment, and those tax benefits can be significant.
Yeah.
Very good. I think we have time for maybe one last question. Perhaps we can, we've talked about migratory trends, tax regime trends. do you see other trends that real estate investors should take note of in 2021 that we haven't talked about today? Josh Roach, maybe we'll let you.
Look, I think storage and industrial storage is fascinating. You've got the amortization of things, and so provide storage and industrial storage around that is something to look at. That's not new though. The second thing is cold storage is something that family offices have just begun kind of thinking about holistically as an asset class rather than just long-term cold storage folks. But cold storage real estate is another fascinating